Good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for March 10th, 2013. We have a market that is bullish normal. On an annual basis using weekly RSI 14 for the first time in a long while, we are in overbought conditions on an annual basis with a score of 74 out of 100. The 10-day NDX short-term market condition is overbought with a score of 108. The percent stretch relative to the 200-day moving average is green bullish at 10.23%. The slope of the 50-day moving average is green bullish at 0.81%. ADX remains steady at about 24.8, just a shade under 25, which is the threshold for strong trend. ATR percentage is at 1.05% at the higher end of normal. The risk index, which is the 30-period moving average of the VIX divided by the 10-period, is at 0.98, which is right on the boundary of risk on, risk off, and that has a z-score of minus 0.29%, which you can see on the time series. The risk index has rolled over. The risk Z has rolled over and is now almost back to break-even line. Blended monthly balancing report portfolio, no change until on or about 1 April. ETF2, the theoretical model is still at 100% exposed, and we're just updating stops this week. No trade of the week examples due to the academic conference I was attending. Looking at the blended monthly rebalancing portfolios, again, you can see in the 13 ETF, only treasuries are on a cash. Everything else is on a buy signal compared to the 4-month moving average. And the top three, Australia, the Russell small caps, and Asia less Japan. And in the 26 ETF, same top three with the addition of XLF, the financial sector. Market health check. The vertical blue lines are 10, 20, and 30 days worth of look back. The thick blue band in the center is the 30-period regression line plus or minus 1 standard deviation. That's the river. The lighter toned blue is plus or minus 2 standard deviations. That's the floodplain. The orange ribbon is the 2-period Bollinger Band acting as a real price. And you can see that price and the ribbon are outside of the floodplain, so we have runaway market to the upside here these last 3 to 4 days as it cleared previous swing high at 153.5 and is now at all-time highs. Thick black line in the middle is the 30-period regression line. The outer black lines are the channel formed by the maximum excursion from the regression line during the look-back period, which happened around here 25 February or so. So the market, the price is still within the regression channel, just outside the floodplain. No resistance overhead. The river is pulling away from the 200-period moving average, which is the thick red line, and the shaded area underneath. ADX has hooked back up to 25. Bulls are decisively in charge. We've been overbought now for about 5 days, and you can see that the jaws of the percent price oscillator are open to the upside. There was this momentary sell-off and then the weakness here, but that made the crossover here when price looks like about Monday at the close, and then the jaws crossed and open to the upside, so we have some room to run to the upside. So all systems go on the long side. The horizontal red lines are support levels that have held in the past and which would be profit targets if we had failure back below 153. Failure here, the first target would be looking at is about 151-ish, 151.5, which is the Bollinger Band mean, the middle of the river, and this support level from the previous move up. Then 149, then 147. But right now I would expect the previous resistance level at 153.5 to act as the first line of support. So we'll see if that holds. That's the edge of the river. That's where we would expect, if the bulls are really in charge, that if there was any pullback, it would halt there. So this is looking very favorable for the market. ETF2 regional report. All of the regions are on a buy signal. Market is in bull normal. That's why we're at 100% invested, 0% cash. Globals are still slightly better than the U.S. Inside the U.S., it's small caps, mid caps, large caps, tech. The two strongest sectors have now rolled over, based on STR, to U.S. small caps and mid caps. So their rotation is coming back to the risk on in the U.S. and away from the globals. The two weakest sectors, U.S. tech and emerging markets. Inside the world market model, looking at the U.S. first, everything above average except U.S. tech, and then the mid-cap value is very strong in green. Asia less Japan, and Japan above average. You can see the leaders are the smaller emerging countries: Vietnam, Indonesia, Philippines, Thailand. Latin America above average, emerging markets slightly below average, Canada slightly below average. Anything Europe is above average, with Sweden in the strongest position. Looking at the global sectors, you see the U.S. is in front on energy, finance, which is in the green, that's XLF, utilities, healthcare, and parity, or the globals in charge on materials, industrials, tech, staples, and discretionary. Looking at the top 30 in the ETF database, these have a minimum of 100,000 shares of average daily volume, and sorted by relative strength, the blended relative strength. Solar ETF, Japan total dividend, Vietnam, Philippines, home construction, transportation, Thailand. Being dominated here by Asia less Japan countries. Although it's healthy to see that both home construction and transportation are among the absolute leaders, that really argues for a return to strength in the U.S. XLF still doing well, that's the financials. Dow 30 based on the same lens. I want you to notice that Hewlett-Packard is a 100 on strength. That means it's when you put the Dow 30 inside that 1500 ETF database we use, Hewlett-Packard is at the very top. So its price is now up to 21 bucks. That's almost 100% gain off its low of the last quarter. And once again, none of the Dow components are in the red on relative strength. And these three here, Disney, United Tech, and Home Depot, are green on strength and white on average, and so that means that the money is flowing into those sectors. Still some room to go. The financials up top also, JP Morgan, Bank of America, and Travelers. And American Express has made a nice recovery and rebounding well. Cisco near the top. Pfizer's made a nice move off the bottom. Johnson & Johnson extremely strong. At the bottom, Merck, United Health, Alcoa, Walmart, ExxonMobil. Microsoft starting to make a little move off the bottom as well. We'll shift to the daily report now. See the time series of the 10-day NDX overbought and staying overbought. The time series on the risk Z almost back to parity and almost at risk on. No signals in the overreaction or channeling. You can see the volatility is right at the midpoint of normal, and ADX has started to hook back up with the bulls in charge. 10-day max pain candidates: United Health, Caterpillar, Alcoa, Microsoft, Merck. That's sort of the value plays. In the ETFs, it's the VIX, gold miners, treasuries, gold, and gold. Treasuries on a 5-day down. And then on the auto framer, we only have treasuries, Cliffs Natural Resources, and the blended commodity ETF. Not surprising when the market's at an all-time high. All of these pattern trades need to have some pullbacks from measured swing highs to be able to really find those 2-to-1 reward to risks that we like so much. So right now, it wouldn't be wrong to stay with the stronger candidates: Bank of America, McDonald's, Disney, IBM, Johnson & Johnson. Interesting to note that the two weak sectors of Latin America and Brazil, ILF and EWZ, are both 10-day min pains, meaning they're closest to their 10-day high. That could be a sign of value play there in South America. Very few signals at all in the Dow Tactical 30. None of the max pain range compressions, nothing tests out at better than 2-to-1, just a handful of dojis as well. Inside the ETFs, treasuries at 4.8 reward to risk ratio are number 2 on the max pain range compression and a 5-day down, and had a RSI2 closing value of 2. The VIX had a closing value of 9 and is the number 1 max pain range compression. Among the leaders on Friday: coal, Latin America, consumer discretionary, and natural gas. All of these that fire in the green were ones that had new highs on a 10-day. They closed above the 10-day high. A 152 reading in Latin America ILF means that if you took the previous 10-day trading range, this closed more than 50% of that range higher than the previous 10-day high. So quite an explosive move up. And that's how you can estimate the size of the move with respect to the previous 10-day trading range by looking at that index value. 30-day regression line in the market mosaic has bought back all of the big sell-off day from a couple weeks ago and is now pushing new highs. The regression line came back to the 6-month average and now has made a cross over its own 10 period. And on the zoom in, you can see how that is actually very positive. When it makes a crossover here, that means that there's room for another nice leg, and as that could be another 5 to 8% move off of this pattern here. As long as it holds support above 153.5, another 5 to 8% is certainly available. That's 7 to 10 points higher in the S&P. You can see price with respect to the 200-day moving average is now 2 standard deviations off the 6-month average, and so that's very favorable. Though it can still go further here now based on simply the regression line analysis. This is very bullish. The VIX is now on the Z swings is now all back in the yellow, and then the 10-day loss in the VIX is a 2 sigma adverse move. You can see the strength over the as a 10-day holding period has been exceptional in many of the indexes, so this has been quite a move. The Z scores are the regression line slopes. You can see the 90 left the river and is still steaming northward. That's very favorable. The 30 pulled back to the mean and has resumed. The 10 period hit the bottom of the the -1 channel, went through the +1, and is sort of at a natural respiratory pause. It would not surprise me to see a pullback here, but if it could stay above 153, that would be extraordinarily bullish and an opportunity to get even longer. And you can see that price is now outside the river. The expanding volatility of the upside is causing the river to get a little bit wider here now. You saw it pinched in during this moment of hesitation, but now is starting to expand to the upside. This could be the third leg. If this is the first leg here and this is the second leg, we could be seeing another third leg develop, and that's why 160 is in sight. And the rest of the charts I'll just scroll through for your reference, but no commentary. This is Ken Long from Tortoise Capital. Keep your powder dry and your risk measured.